already, make sure to follow us on Instagram and Facebook at Everything About Wealth. Hey guys, and today we have again the opportunity to interview. His name is Dr. Joshua Harris. He's a previous professor at NYU and UCF, and actually met him when I started investing at one of the investor clubs, and then from there was able to take some courses doing my master's with him. Josh, are you there?
I'm here.
Excellent. Thanks for being on the call today with us.
My pleasure.
So what's going on? I kind of did a little bit of an introduction, but I know that you're working on a new opportunity. Can you tell us a little bit of your next adventure and a little bit more about yourself?
Yes, and in just a matter of days, I'm going to be starting a new job full-time in the real estate development industry as the Vice President of Strategy for Skanska USA Commercial Development.
Excellent. And Skanska doesn't ring a bell to me, but how long have they been in business, and do they only do development, or what's their background?
Sure. So Skanska is a fairly large multinational real estate development and construction conglomerate. They're actually been around 132 years. They are headquartered in Stockholm, Sweden, and the U.S. operations are headquartered in Manhattan in the Empire State Building, which is where I'll have my office. The commercial development arm, which is new to the United States, they came in 2008, kind of in reaction to the downturn, has been active in Boston, Washington, D.C., Houston, Seattle, and Los Angeles. And then part of my role will actually be looking at new potential markets and new strategies for them to grow.
Excellent. Sounds like you're going to be having a lot of fun.
I sure hope so.
Excellent. Well, I'll start the call. A lot of people are concerned about what's going on today. We have trade wars going on. We have an economy that's, fluctuating a lot. People are a little bit concerned, and the media is talking about a lot of things. But, what's the state of the economy? What's the state of our market right now, Josh?
Well, certainly, like I always say, there's a lot of ways you could view an economy. There's a lot of ways you could view your own health or a business's health. So you can probably find data points to make whatever story you want, and as the nature goes. We have been right now, we are in and have been in what is right now our longest economic expansionary period in history in the United States. It's been over 10 years. We hit this milestone in July of this year, and we've now surpassed the one in the 90s, which was pretty famous for its long-term up-bend. So I think when you get in this long, it's natural people start to expect that we will have a recession before too long. It's not a bad expectation, and certainly people are having it. So we are seeing a slowdown. GDP growth has fallen from 3% down to 2%, which is still pretty good. We have seen business investment where it was pretty robustly positive through 2018. It has turned negative as of sort of the second quarter of this year. A lot of the trade wars and some of this general uncertainty has caused businesses to pull back investment dollars. So there's a good chance that we're in the midst of at least of a little micro recession right now in certain like manufacturing or certain trade related areas. And it could spill over in the next couple of years into maybe a mild macroeconomic recession. And you're starting to see increasing belief and probability of such.
Wow. And I know you're saying, because a lot of times, like we've been talking about, a lot of people are concerned, like, oh, we're waiting for this. It's going to be a recession. It's coming any day. But you're just saying right now, it's really a slowdown. I know something else that they talk about in the market is the yield curve inversion.
Yep.
and what that kind of is, signifying as well. Does that also, you think, roll into the play of what you just said as well?
Well, the yield, it's funny. People don't usually talk about the yield curve until there's some weird reason to put it into the news. And we did have we did have this thing called the yield curve inversion. And it inverts and it uninverts. What that effectively means, just in simple terms, is that it's more expensive to borrow short term, meaning that your short term borrowing rate or the interest rate we get on bonds is higher in the short term, like over 90 days or 2 years, than it is, say, at the 10-year or even maybe the 30-year. But I mean, this is mostly the 10-year one they look at. So, and the reason why people are worried about this, or why it historically kind of is considered it's considered kind of a harbinger of recession, not because it doesn't have anything to do with causing a recession. Mm-hmm. It's just sort of an indication that market investors saying, you know what, I'm really afraid of the future, so I want to pile into these long-term 10-year government-backed bonds for safety. And if their reason they're doing it is because they fear the economy. So the what I'll say to it is that it's a really not a great indicator of when a recession is going to happen. If you look at the history on this, they'll say, oh, the yield curve inverted, and then a few months later a recession happened, and then up to as much as 2 years later. So it's not a great predictor, but almost all recessions have seen an inversion and some part of the time before. So I think the big thing that's driving this one in particular really had very little to do with the United States, mm-hmm. but a lot to do with Europe, with Brexit, a lot to do with even the Asian slowdown, and all these foreign investors began piling in to buy U.S. bonds because basically the U.S. is pretty much the best economy in the world. Mm-hmm. So I'm not quite so sure that this signal has the same meaning, say, the ones back in the 60s that people talk about, because there was a lot of this was a flood of global capital that came into the market.
You're saying the yield curve, and a lot of experts, some of them, they swear by it. I don't know if it's just because that's a great way to catch attention in the media or what, but every time you see maybe CNBC or any type mm-hmm. of these financial websites, Reuters or whatever, they're mm-hmm. talking about the yield curve. And I know it makes a lot of people, scared about the market. One market mm-hmm. that we particularly like to play in, that we focus on, is the real estate market and the investing mm-hmm. side. And we know that in 2000 and after the 2008, 2009 recession, we know that the real estate market got hit. And I know that was mm-hmm. majority of that was subprime mortgages. But if there is a recession in the short term, do you see, or even in the longer term, do you see that the real estate market is going to get hit? And if so, how do you think that that's going to happen?
Sure. Well, anytime you have a recession, I mean, by definition, a recession is a contraction in economic growth, meaning that we're producing less, we're spending less. And usually the next resultant thing, if we're producing and spending less, that means that we're hiring less, and that typically means layoffs. Mm-hmm. Anytime you have reduced activity and you have layoffs, you're going to need less real estate, be it apartments, office, retail, you name it. People contract, households literally contract. People move in with their families, storefronts close, offices close, businesses close. So if you have a recession, it's virtually impossible to not see, at least on certain regional or city basis, you're going to see some impacts to commercial real estate. Just how severe it is the real question. The interesting thing about the big difference between the 2008 recession and what they sometimes call the Great Recession or the global financial crisis versus what is likely to occur in this. Let me just flat out say it, there will be a recession. We're not, we didn't end recessions. The business cycle didn't end. It's just a matter of when. And is that when 2 months, or is it 2 years, or is it 10 years? That's the debate. It's not like it's never going to happen. I think nobody believes that either. Yeah. But the difference in this time is that, the 2008 one was really a debt-fueled financial crisis, and a lot of that was in real estate. You mentioned subprime mortgages, which was one of the areas that was massively overextended, and you had really terrible credit terms. You're in Florida. I was in Florida at the time. They were just giving mortgages to people who had absolutely no business getting them. It was just I mean, to call them a bunch of drunken sailors would be a real insult to the drunken sailors. And it was really bad. And truth be told, and maybe you don't realize, but it was almost as bad and even dumber in the commercial real estate and many of the development markets. So you had overbuilding of practically everything. You had prices were going up simply because people just wanted to buy stuff. There wasn't real demand growth. So when you entered '08, I mean, you really had this perfect storm that real estate was going to take the hit. Well, in this most recent, this long 10-year upcycle, it's been almost the exact opposite in real estate because of how bad it was in '08, because how regulators have come down heavily on banks. Lending standards are very tight, debt standards are very tight, and there's really been very little on a relative basis of new development in the past 10 years. You think about it, you're in Orlando, think about, there's really the first real downtown office building that's been built since the recession. It's just under construction now by Lincoln Property Group right there by the Sunrail station. Mm-hmm. There really wasn't, I mean, I've seen a lot of apartments, but there's been a lot of demand for that. So, you're really looking at a lot of statistics that suggest that we're on a nationwide basis undersupplied. Now you'll find markets, in fact, I think even up in New York City where we've had lots of office development, I think, you can easily find markets that are going to be oversupplied. That's normal. And certainly where a recession comes, if it hits that city and the business of that city, you're going to have problems. But I actually think real estate, not only is it probably not that sensitive in this next recession, it might actually, and this goes back to all that foreign money, it might get a lot more investment capital because people are going to be looking for yield, looking for, better real assets. The same way, if you ever hear of people how they want to buy into gold, sometimes in reaction to, well, I mean, real estate's also a hard asset. It's also literally called a real asset. So if people like the returns and they want just something that's sort of literally safe and stable, you could see in a weird way certain assets getting bid up because of the yield perspective. So that, it's a double-edged sword. You'd rather not have a recession, right? It doesn't, certainly if you're managing a property, if you have vacancy, a recession makes it hard to lease. If you do need to sell a property, you're maybe or may not getting as good pricing, or may take longer to sell. So it's certainly, if you're an investor, you're not going to be thrilled by it. It's not countercyclical. Real estate will not go up greater in a recession generally, but I don't really see the setup of this one having too many particular pain points and nothing like what '08 was. At least that's the way it looks right now.
Well, I think Desiree's happy to hear what you just said.
Yeah. Let's hope it's true.
Yeah, she we had a conversation about this recently, and she's mentioned it several times. She said, yeah, a lot of people are saying, investors that invest in maybe houses or small commercial apartments or whatever. What have they said, Desiree? That they're waiting?
Well, they're betting on the recession coming. So they're just saying, I'm waiting for the recession to come, and then I'm going to buy up all these properties. Yeah. And I'm just saying, so is half the world,
Yeah.
So it's going to be a very different market, as I see, exactly what you said. There's going to be more capital in the market.
Mm-hmm. Absolutely. It's really funny you said that. I was actually thinking of a point that I made when I've had this discussion. I'll say, I think I've had, I've been giving kind of economic presentations, sort of. I've been a real estate economist since, out in the public since about 2010, thereabouts. So I started in the midst of the downturn. So I've been through, it's always fun. It's always fun. You can tell that increasingly you'll even notice people's views on the economy seemingly get colored by their political views. So when the presidency shift, all of a sudden, who was heckling me shift, and it was just crazy. And one of the things I've always noticed when I get these sometimes. I'll come across people who are very bearish. And actually, I had a call literally this morning with a friend of mine who works for. He's kind of, I guess will be somewhat counterparts, but he's somewhat ahead of strategy or research, or just part of he's part of a big a Florida-based developer that does stuff across the country. I don't want to say the name, but we were talking about this, and he showed me kind of a presentation that they had to their investors. And this is this guy came from a big, Wall Street investment bank before he went into real estate development. And it was very, very bearish slides. I had shared with him mine a set of slides from a presentation I'm giving next week at a NAIOP conference. And he said, wow, you seem more bullish. And I said, well, my comments probably aren't as bullish as you think, because my slides are pretty simple. But we had this phone call to just catch up on life. I was telling him about the new job, and we were catching up on family. And we of course got into our debate about the world. And he has all these negative comments, and he's got the dad, and it's a great listen. All you have to do is just go watch the news. You won't take hard to figure out the kind of stuff he was talking about. Nothing that unheard of. Very put together, very well. And I kind of get into this with him about how potentially bad it could be, and he thinks there could be massive layoffs. Where I don't think we're as overhired. I don't think it's as probable, but it's And finally, I get to the point. So what's this mean for your firm, and what are you doing? And it's like, well, we're basically trying to gear up. We don't want to tell people, but we're secretly hoping it happens. We want to use this as a buying point. So I always like to say, if you think the world, it's like I say, if your reaction is, I think the world's going to fall apart, I say, okay, what are you going to do? Well, I want to buy everything. Well, that's not really a prediction of the world falling apart. If you really believe the world is falling apart, you should be selling everything, buying bonds, and getting out of the business. But that's not what anybody is doing. And I've had this discussion with so many people, venture capitalists. I was one guy who theoretically is probably worth into the billions, and his whole view is negative, but he's completely excited about it. So what happens is, if everyone's looking to buy, you're not going to see, if you're really waiting to think that asset prices are going to fall. I mean, they will. When you have bad assets, or you can always have a troubled asset or a defaulted property, and yes, you're going to have to unload it, and that's going to produce a deal for whoever's going to have the risk capital to take something that's not performing. But I think there's so much buyer activity and so much what we call pent up capital. They use this fancy term called dry powder, like as a way of saying money that's kept in the barrels, ready to go fire after deals that can't find deals. So I think that so long as that's the case, I just don't see the prices, as long as supply demand holds, I just think that there's a safety net there. And we'll see. I mean, here's the thing that I always tell people. What you should be worried about isn't what we're debating or talking about, which is like yield curve inversion or even trade wars, frankly. Because the trade wars, believe it or not, more or less, this whole thing has shown that despite what seems like a lot of saber rattling, you actually have two parties on both sides that don't actually want to kill each other because there's mutually assured destruction.
Of course.
Well, yeah. What should scare people? Mm-hmm. It's not. But what scares people is the hidden risk, the things you didn't talk about. Like in 2008, the big thing was no one realized how all these financial institutions were linked through cross-collateralized credit default swaps. And then if there was one hiccup, that it could wreck. And then if AIG went down, and then if Lehman went down, it would trigger an event that could bring AIG down, which in turn would cross across all the major financial sectors. So that's the kind. No one realized that until it's like sort of like no one realized the building was flammable until someone all of a sudden had dropped a match on it. So the fear always in the marketplace is that there's something that we're not talking about, and we're not watching, and you can't really predict them. They call them black swans sometimes. I mean, so I always say that the things that people are known about probably aren't the things to be scared about, and that's just the reality of the world.
Yeah, one thing you just said with the trade wars and the unexpected things and the parties that don't want to basically take it off the face of the earth is the Chinese in the United States. Right now, we're in a trade war with the Chinese because of so many reasons: intellectual property, unbalanced trade, and all these other things. But in the end, American business wants to do business in China. I mean, before these last 4 years, who knew that farmers were so, unless you researched the topic, you were in that industry, that they were so connected to the Chinese market. Like right now, they're suffering because of the political cloud of that. So guess what? That can go. It can't go on forever because American business wants that relationship to succeed. And I mean, Silicon Valley, we can go down the line. And then on the Chinese side, they need American consumption, and they need the jobs in China to fund that American consumption. So I think in the end has to be a solution with that.
Well, I was going to say, I think that, global trade, if anybody remembers like their high school or early college, like macroeconomic textbooks, they talk about trade theory and mercantilism. And there's all these like old style theories about tariffs. they really don't apply today because today's world is a very globally linked supply chain, which is to some extent is why I was looking at some inflation data from the Consumer Price Index, at least the most recent come out. And for all purposes, there's really no immediate evidence that the trade war as of yet, and yet's a big phrase because a lot of this is more talk than it has been actual implemented tariffs. There's no real evidence that prices have increased. And in fact, inflation's so low. And so far, the way that the Chinese have responded is, they've now overtly cut their, lower their own currency, essentially devalue their own currency, which essentially almost ameliorates the effect. They've largely kind of cut and deal because, they had good margins. So, so far, it's fairly accurate to say that to date, most of the cost of the tariffs has been borne by the Chinese. But as they accelerate, that can't last forever. So, you're going to see more random and weird effects. And you mentioned the farmers. There are some, the farmers, it's sort of the farmers and some of the other Rust Belt activities and some of the raw producers that are probably, they're the ones who have seen the direct impacts first and foremost. Oddly enough, when it comes to farms in the United States, we had this great history of subsidizing and doing all kinds of weird programs for farmers.
Yes.
So they were somewhat set up to solve that. The history of trade and farm is so crazy. And if you understood the political power that farmers have in the United States, it would shock you. So there's all kinds, they'll get paid. It's an incredible thing. What happens with it? I think the interesting question will be, is what, is how far is China willing to go? Because I think the model they followed is, well, I think they believed that there was a good chance that whole Russian Robert Mueller thing would actually maybe take Trump out. So we'll just wait it out. And now they don't expect that. Now they say, well, maybe there's a good chance he'll lose the election. So let's, we can take it a hit. We'll take the pain. Maybe we'll cut our own prices. We'll cut our currency and we'll smoke it out. I don't know what the real big question will be is how this election plays out, because if they start to suspect or at least think that there's a more decent, realistic probability that Trump gets reelected, which I don't know how anybody could really rule out. I'm not really a political prognosticator to have any great wisdom, but I don't know how you couldn't move away from at least a 50-50 baseline expectation. If that's the case, China has a lot of motivation to maybe do a deal. Both parties, this is the interesting, I always love game theory and dynamics, and both parties have an insane benefit to potentially doing a deal before the election so they could both, because for Trump, it's easy, right? He gets a win, stock markets pop, I'm the greatest negotiator ever, but you can just imagine the tweets and the speeches and you can just imagine it. You can even, the jokes write themselves, right? You don't even have to, so that's Trump. But think about in China, if they don't do a deal ahead of the election, Trump is in an incredibly strong negotiating position after the election. Mm-hmm. And to some extent, Trump is so my own prediction, if I had to guess, and this game theory stuff plays out pretty good actually sometimes in predicting political moves. There'll be a deal. Will it be the greatest deal ever? No, it will be improvement, but it'll be very face saving. It gets back to sort of a good level of improvement on both sides. You want to hear a crazy story, just how crazy how bad the treatment the U.S. companies get in China. I was in Shenzhen, which is effectively it's kind of like their Silicon Valley. It's just right over it's just right above Hong Kong. So it's the first major city into mainland China. And we were getting toured around. This was a real estate trip actually with NYU. And one of the things that some of our hosts were telling us while we were in China is how there are these, in various parts of the country, there are these fake Apple stores. Like literally they make fake Apple phones from the local producers. They have whole stores that are made to mimic like a US Apple store. And this is how far it goes. The employees of these stores actually believe they are Apple employees. They are not Apple employees. They're not selling real Apple phones. It is like, it's not like if people think about counterfeit goods, like you're in New York, I always tell my wife, she likes Louis Vuitton. So I get a great deal. So the sellers come out at about 8 p.m. on the street right on Fifth Avenue. Discounts are massive. That's not $1,000. That's $30. That is not the kind of counterfeiting that they're talking about in China. I mean, it is overt. It is on the retail storefront. And that's just one example. So, I mean, I don't know if that's I don't know if Trump will make a deal that's going to get rid of that. I wouldn't hold my breath. But, I think that the depth of the problem is pretty severe. So, I mean, and I don't think China's unaware that they have gotten the benefit of a fairly light touch policy by the U.S. and Europe, because they've been in a growing economy. And as much as people talk about China's still relatively small compared to the U.S. They get overplayed a bit, but they've got motivations to do a deal. I mean, they are really getting hurt. They face so much more risk in this trade war because as the supply chain shift to places like Vietnam and Cambodia, and if Mexico ever gets themselves together, Mexico could take over all of this production and do it cheaper and ship it by train and everything into the U.S. much easier. So China as a supplier takes so much more risk in a global supply chain type of a place. Now, the U.S. takes some risk, but it's more short term. We take short term risks, they take long term risks. So I think there's a good reason for a deal, but I'm not at the negotiating table, so no one's listening to me.
I actually have a follow-up regarding that, because earlier today, early in the on the call, you had mentioned that we have a negative investment in businesses right now in the economy that's kind of hurting us. Can you go a little bit more details about that? Like, is that from a global, are we being affected by the international investors, or is it just people here aren't starting businesses? What does that mean?
So the statistic that I'm citing it's one of the major subcomponents of GDP, gross domestic product. It's called private fixed. If you want to know, this is the long, boring government name. Is actually private fixed investment, non-residential, just because that's the way they code everything. It is generically business investment, so it's things like factories, heavy equipment, machinery, large durable purchases. Things that generally go into the production element of the economy. So the decline in it is that essentially the amount of money that the American business and sort of the American economy is putting in on an average rate. So it's like the amount of money invested is now declining from its prior quarter reading. Why it's happening? Nobody ever really tells you. My gut feeling for everything reading is that essentially businesses are looking at the trade wars, or looking at the political instability, they're looking at Brexit, the global instability, and say, you know what? I don't know if we should invest in that new plant. I don't know if we should hire those people. Let's just wait. And I'll give you I'll tell you another data point that actually preceded this, that it should properly, because it's supposed to be a leading indicator. You've heard of consumer confidence, right?
Yep.
So that's been doing pretty well. It was pretty flat this month, but it's been doing pretty good. There's another measure. They only do this one quarterly. It doesn't get as much press, called CEO confidence, and it's a survey of CEOs in major U.S. companies. Any reading over 50 is considered more positive in the sense that the majority are voting for growth and are planning for growth. Any reading under 50 means more are voting for contraction or expecting contraction. So for most of 2018, it was well above 50, even above 60. At times, very positive CEOs were expressing growth. I mean, their optimism, obviously, it shot up when the tax cut passed. It shot up, and that, of course, that's what we saw. We saw a big shoot up in business investment and hiring too. As soon as I think the first catalyst people don't even talk about anymore, but was the government shutdown, which lasted quite a long time.
Right.
That came, and then in 2000, and at the end of the fourth quarter, it fell. It dropped by 13 points and dropped beneath 50, and it has stayed there, basically flat all the way till the end of the second quarter. And so more CEOs are saying, you know what, we're uncertain. We just don't. Our businesses are doing okay, so they have subcomponents. They're current businesses. They're not losing money. They're not needing to lay people off, but they just don't have the confidence to do the expansion, and that's what's causing. So we've seen that's why GDP went from 3% down to 2%, which is not, that's what it's been for the average over the last 10 years. So it's really, that's the funny thing is all this slowdown, all this, if you watch the news, how negative they make it sound. Frankly, from the numbers, it's just going back to kind of where it averaged between say 2012 to 2016. It's not. No, it's just slower growth. It's not it's not negative moves.
Okay. Very interesting.
Mm-hmm.
I also have been reading also a lot about a concern with business debt in the economy, that it's very high. And that can also possibly be a problem for businesses that have leveraged themselves to grow. And as soon as if the market is to turn just so slightly, they may be in trouble. Do you also see that happening in an economy and affecting the economy as well?
Yeah, I mean, one of the points that is definitively a major risk, and actually my friend who I told you about earlier, the developer of this was one of the major points. So debt utilization by businesses has gone up. The debt to if you're familiar with like a debt to income ratio, or like the debt coverage, the interest coverage, because interest rates have been so low, is very minor. So while the debt, sort of the gross volume of the debt is high, the payments are low. Now, the problem is most business debt has terms between as short as 6 months to maybe 5 years. Corporate bonds don't tend to be that long. So the risk is, the risk was this last year, everyone talked about this because if interest rates were going to shoot up, which is what people thought was going to happen, everyone's like, imagine you have a mortgage at 3% and now it's coming due and you have to refinance and the best rate you can get is 4.5% or 5%, right? I mean, that's going to shock your budgets. So that was the fear. Well, right now, the interest rates have gone down. So to some extent, businesses can refi. They can, if the risk, that risk is real, but they can actually kick that can down the line by refinancing. And I think most are going to. So that's been reduced. The risk that I think people are probably more worried about on the long term that's pretty legit is then just a very big increase in run up in the public debt, not just in the U.S., but even across the globe. The debt to GDP, the government, the interest on government bonds, which has been minor because, 10-year treasuries are like 1.5. And even the 30-year bond is out like below 2%. So the interest rate on bonds has been minor. So we've been able to fuel all these increasing budget deficits that we in the U.S. and most of Europe and other places have with cheap debt. Europe's got negative interest rates. It's basically free money with a discount even. If interest rates were to move, or if the economy slows off, because we got debt above GDP, then you could see government insolvency issues come up, and that's a little bit scarier. That's a scarier thing, and as long as the economy keeps moving, it's kind of like if we all hold hands and walk together, we are okay. But if people start getting afraid, so the debt bubble or a debt bomb, as I've seen it called, I think it's a risk. So long as we keep growing and interest rates remain low, which is what people think will happen, especially on the interest rates, it's a bomb that doesn't go off, but it is a risk. And I think people are it's funny because people are definitely right to think about it, but I have not seen any large mass of investors selling bonds or moving away from government debt at U.S. or other places as a result. So people talk about it, but nobody is acting on this fear.
And
that could change.
Yeah, no, definitely that could change overnight. Interest rates were supposed to be going up years ago. I remember 5 years ago, it was talked about, oh no, interest rate, they couldn't stay this long forever and they're going to be going up. And that's the research that I was doing too. And I said, everyone I told, if you're going to buy a house, do it now. If you're going to try to lock in long-term debt. But crazy thing enough, now this year, interest rates dropped again. And then it looks like the market, because of some of this instability, it's what's led to it. Now, are we in a situation where, is this the new normal? Where interest rates are going to stay pretty consistently around this, 3.5 to 5.5 range?
So I will tell you, Dave, you've probably been at some of my presentations last several years. If there was anything I was sort of consistent on since at least 2015 is that I said, well, look, the economy keeps recovering, GDP keeps growing. You do all the sort of back of the envelope calculations, we should see more inflation. Especially when unemployment fell down to 4%. which means we should see higher interest rates. And I've been through most of 18. If you watch my presentations, I was saying be prepared for higher interest rates. And if you're a commercial real estate investor, that meant maybe higher cap rates, which means lower values relative, obviously relative to income. These were my statements that I was making. But it was always predicated on sort of this continued growth mode. I said, we'll probably have a recession, but it ain't going to be now.
So, Josh, what are some of the real estate asset classes that you think are going to be prominent in the declining state of the economy? So, and you could even expand that to other asset classes that you think would be a good safe bet or a good opportunity.
Well, the first point I would make is, real estate is a notoriously long-term investment. People buy real estate, typically finance it with 5, 10-year, even sometimes longer horizons. So I wouldn't preface a strategy on what would be a recession, which are typically short-term events. So I think anything you buy, you should have a long-term view. And to that end, I think if you take a very long-term, 10-year plus view, the economy, the U.S. looks very strong. So I don't know that. I think a recession at best should be used as, how do I use as an entry point? Can I find cheaper properties? Can I maybe find cheaper debt? How do I use it to enter? But I don't know that it would change my strategy of what I would buy. To that end, I think you look at fundamental supply-demand balances. So in a lot of markets, we have shortages of housing, or certainly shortages of affordable housing. We are seeing shortages of things like senior housing, which is a demographic play. Some places, student housing. We're seeing, it's interesting, some of these are sometimes called alternative real estate classes are getting very popular for demand reasons. Self-storage is interesting. So, I think you could probably make a case that in any market where you have growing populations and growing job bases, you're going to probably find good returns in the sectors as long as you buy in those locations that people are going to want to live, where they're going to want to work. And I think that there's a lot of different things you could go to. I wouldn't want to blanketly endorse one or condemn one thing just to say that in every given market, if there's a need for it, someone's got to own it and someone can make money renting it out.
Got it.
I actually want to touch on the affordable housing that you spoke about earlier. What is your opinion on the lack of the availability of affordable housing? Do you think the tax credit system we currently have is the best solution, or what are some things we can do?
Yeah, it's interesting. The government, if you look at a lot of the taxation effect, both on federal, if you look at the state programs and the local programs, you will see that consistently the government has put a lot of effort to trying to subsidize housing, even if something as simple as offering a faster depreciation schedule, meaning a bigger tax rate off the residential assets as opposed to commercial assets. That's a simple thing they do, and part of the reason why is to hopefully encourage investment and development of residential housing. Yeah, it's a complex thing because construction costs keep rising, land is not cheap. So the result of it is that I think the reason why there's a shortage is different market to market. LIHTC has worked well, but it's limited, right? If you've ever talked to a LIHTC developer, that's the low income tax credit, LITC thing people talk about. It's a very limited allocation. It's a huge bidding war. Clearly, the government could issue more, but it works successfully when it gets issued. So, clearly they could increase the size of the number of those credits that are allocated, and you would build more of it. So that's an easy fix, but we don't see it. Opportunity zones is a new recent thing that is somewhat targeted to hopefully, because in theory, these opportunity zones are areas of lower income. So in theory, the tax benefit will lower the cost of capital, maybe cause more development of things like affordable housing. I think the problem with it is it's difficult to build, and I think the bigger challenge is up in New York where I am, which I don't think this is a challenge as much in Central Park, but the big thing in New York is it's just impossible to get zoning and to get the top. It really is a fact of that things are just so expensive that the areas that should be built with affordable housing don't have the zoning and they don't have the transit connected to do it. So I'm talking about parts of Brooklyn or parts of Queens. And instead they do these crazy deals where they basically make developers agree to, you must put 20 or 30% into an affordable pool in order to basically get a tax benefit or anything to build the entire thing. It works to an extent, but it's a really short-minded viewpoint. And in fact, New York just passed a law really strengthening the rent regulations, like rent control laws. restricting the ability to increase. And guess what? You've seen already a bunch of projects to renovate affordable housing, like the big story of Essentown owned by Blackstone. They're cutting back the investment. So I mean, they're making the wrong move there, because all of a sudden, if you don't, the only way you solve affordable housing is really simple. You have to build more housing, period. There's no strategy. And I've seen so many governments, especially New York and San Francisco, where they argue over, they want to put the screws to the developer, make it really tough. And then guess what? Nothing gets built. So, a vacant lot with overgrown grass isn't helping anybody. And I think that, to me, is the biggest policy failure I see, is the zoning, the sort of the exclusionary zoning, the refusal to sort of almost, you said that, well, we got to extract so many rents from each developer that then they end up pricing everything out to where they don't build anything. So that, to me, is a big challenge. That's the reason why, at least as far I can tell.
For people that haven't heard it, Free Economics has a great episode on rent control. And they really go deep into the subject, and they talk about who benefits and who hurts. And in reality, in the end, rent control, it's not effective for the overall population of the people that need it. The people that benefit are the people that already basically have homes and they're renting. But the people that are coming into the neighborhood that really need affordability, they don't. And
they don't get it.
They don't get it. And then it's a small percentage, even the ones that do, that are already there. So.
And I'll tell you, here's a story to, if you would say, make your listeners maybe angry. I have a friend in New York who, he's not a high income person, but not a low income person either. He's a kind of a university staffer type, to give a sort of demographic sketch. And he had a rent, I think it was rent control. I don't know if it was rent control stabilized, and what the difference is hard to say, but he had this loft in Soho, and he had lived there since like the early 80s. And Soho, if you know anything about New York, is one of the most expensive high-end areas. But I got to tell you, back in the 80s, it was a horrible area. It's totally changed. So he had this, and he was paying literally like $1,200 a month for this loft studio apartment. Not very big, not very nice, but in a really good location. Do you want to guess how much money he was offered? And he took it from the developer to buy him out of his rent stabilized contract?
I would say, to throw out a number, maybe $300,000 even.
It's funny. Everybody I ask throws out a number close to 300 or 250. That seems to be whatever, and that's great. That's like a price of, you can buy a nice house in Florida for that, right? I mean, that sounds like a great deal. Would you believe it that he got $1.2 million?
Oh my
goodness!
I would move too.
No, for my friend, I love my friend. I am so happy for him. He just set him up. He bought a really nice kind of studio condo up by Harlem. He loves it. I mean, it's changed his life, because he was not someone he did not come from money. He came from a poor background. I mean, I'm thrilled to pieces for my friend. But I'm just thinking, like, he is one lucky SOB, as they might say. And a lot of his friends who are other parts of the country or places, they're just getting their rents jacked up, or they're, so it's a win. So you're right. It creates a winners and losers. And he's a winner, and the person who lives in the cheap apartment is the winner. Watching people try to move in New York, I watched this with the students at NYU. I watch people try to get started. I mean, it ends up people are renting cots and beds for ridiculous money. So it's a problem that I unfortunately, not to depress you, I just don't see it getting fixed anytime soon. I don't see the political enlightenment coming around.
Yeah. I think I can agree with you. So it's unfortunate.
Yeah.
Now, talking about problems getting fixed or not fixed, and one of the big ones that I wanted to ask you about is, and I heard it's about the national debt. And I heard an economist recently, it was 2 years ago, I think, I went to a Urban Land Institute event, and very good banker that he worked for the economic department. I think it was of SunTrust or something like that.
Okay.
And he said, look, the national debt is $50 trillion. The national income is $50 trillion. A consumer that owes basically what they make on an annual basis should be fine. What are your thoughts on that? Is that a concern, not a concern? the national debt at where it is now and where it's headed, 50 trillion, 100? When does it pop?
Well, it's not that. I think the real number is closer to like 20 trillion. I mean, of course, when you're, for the average person, what's 20 trillion versus 50 trillion, right? That's kind of an irrelevant distance. But, I think, so, there is this measure called debt as a percentage of GDP, right? So there's the amount of debt and then there's the annual GDP. Now, debt is a fixed number, or not fixed, but it's the balance you have, where GDP is an annualized number. So, what the ratio of it, what this person was saying, to give a little bit of explanatory depth, is that it's a bit of an irrelevant. It's sort of like measuring apples to orangutans. They're not really, how much debt you have relative to the income you make during the year isn't normally a relevant calculation. The calculation, certainly if you're in the mortgage or the finance world, is what's the payment on the debt, the required debt service, relative to the annual income. And that is obviously much, much lower. And, so I don't think that the challenges of the debt of itself aren't, that doesn't scare me. What scares me potentially is that because of demographics, we have a lot more people retiring. We have a lot more we have a lot more social entitlements that are just baked in the cake, from Social Security and Medicare. And now, I mean, look, forget now the fact that you have, in the Democratic Party, everyone is kind of moving somewhere towards a Medicare for all proposal, which is fun to talk about. But, the minute you get any numbers behind this thing, suddenly, everyone gets quiet. And there's a reason why, because it's really doesn't probably make much fiscal sense without some radical changes or things that nobody wants to maybe talk about, because it probably will, because if they're honest about it, they're not getting elected, and they know that. I think the challenge, though, is even if you don't make any changes, you could still get hit by this. And I think that the problem with the debt is that right now interest rates are low, and that's also a problem. But if we keep spending deficits, meaning that like this year, right now, and last year, we're going to spend more money in the United States government than we're going to take in. And if anybody who's run a household budget, right, if your income is $5,000 and your bills are $6,000, that's a problem. And if you do that enough, and we're just we're just printing money and/or we're issuing bonds, and we can pay the interest, but we are sort of running up a credit card. There comes a point. It can't go on for infinity, although it could go on it could go on longer, Denny, than you and I are likely to be alive. It is actually possible that you keep because of inflation. It doesn't have to explode. It is the bomb. It's like a ticking time bomb, but there's a reset button, and that reset button is economic growth and inflation. So long as you can keep hitting that reset button, it can proceed for literal centuries. So I think that's why, and I think I know The Economist. I don't want to say the name just in case I'm wrong. I don't want to put words in the mouth of someone if I'm not sure, but I'm pretty sure I know who it was. And I think that, I think that the construct is correct. The risk is that people, I'll give you this little data point that I always find this fun. People talk about entitlement spending, is that, Social Security, which was a really game-changing policy to the social fabric of the United States, and it really put us toward, it was a necessary step to having a modernized economy that wasn't based on all family wealth and farming. It was really important that Social Security gets implemented. When they did it, which was back in the 40s, you had to be basically 65 years old to collect, and that age has gone up, but not very much. But here's the funny part, right? 65. The average life expectancy at the time was 63. So Social Security was basically designed for people that literally outlived their expiration date and were probably infirm and unable to work. Now we've got 65, or now about 67 for retirement. Well, if you get that old, especially because of the advances in medical care, which are phenomenal, you're probably going to live past 70 or 80. Right. The idea that you would sort of be growing up, going through school, you're not really making money till maybe you're 25. Then you'd work till you're like 65, and you'd live till you're maybe 80 or 90. So you're really going to spend 1/3 of your whole life working, and you're going to be probably a ward of your parents at one point, and now a ward of maybe your pensions and government. It honestly makes no sense. So the reality is that you could solve this if you just sort of adjusted or indexed up the age, probably to 75. But again, I go back to that political thing, right? Like I say that, I just murdered every chance I ever have of getting elected to any federal office under either party. No party will take me at this point. Yet I'm just pointing out mathematical fact. And that, because of these things, we just don't want to, we want to fight over these weird Twitter wars or who's got these policies. And like, I don't mean to get too political, but I watch these debates and I'm like, there's substantive real policy questions. And it's like, because I guess they're boring to the moderators or the press, it's like everything is a weird food fight about over some, if we're talking about like busing or something, an issue of the 70s was a thing in one of these days. It's like, we have these real issues. We don't address them. Politicians, they don't want to touch them because if they actually tell you the truth, they don't want to get elected. And unless both parties did it simultaneously, which they're not. So I think that's the risk of where people see it. But, the Federal Reserve has controls and they have ways to protect us via printing money. Basically, inflation is the protection. And then that's what we banked on.
Excellent. Yeah, and I also think that's a concern because even now, especially with like the baby boomers, and if they're living longer, actually people are having less kids. So there's going to be less people paying into the Social Security system. So that's going to be a concern in the future. If there's actually going to be enough.
Yeah. Actually, I can't remember the numbers, but it was something like the original part of Social Security. There was something like for every one recipient, there was like 5 or 8 payees in. So essentially one recipient for 5 to 8 people making a payment to pay them. Today it's gotten down to, I think, 3 to 1. Like for every one recipient, there's 3 payees, and it could go down as low as 2 to 1. Now, eventually, and I hate to be more morbid about this, but it is just a bubble, right? I mean, once that baby boom, once that big demographic bomb kind of moves through and effectively dies, it actually gets all to be smooth sailing, right? So, in some ways, our kids' generations, they're probably going to they'll get to like what Japan is in when they actually get to the declining population. Where actually, it's funny, I was in Japan this year, so the country is very different in part because of the declining population, they have increasing wealth. So in there, inequality is falling. There is more than excess capital, and all the big political divisions that are pretty common in the U.S. and Europe and other places, they don't have it all because the statistics just don't produce it. So weirdly enough, if we can manage through this glut of people, the backside actually looks pretty bright. But we're talking many decades here. We're talking where we're going to be in retirement for this stuff to play through.
Yep. No, I think that's a good point, and I think you've enlightened us with so much great information. Yeah. Those are some of the things that heard about those demographics. I'm glad you mentioned them. I think I forgot what the book is called. I'll post it in a review of the episode. But it basically talk about demographic shifts and the generation after the baby boomers is actually a small generation, the one in between the millennials, and that one actually
the Xers,
the Xers. So I think when the baby boomers retire, morbidity pass away, then I think that's going to help with some of the entitlement system that's going on. But Josh, I want to thank you for being on the call with us today. We really appreciate it.
Great. It was my pleasure as well.
We appreciate it. And I think we definitely would love to have you back when a couple years out, maybe when you are kind of with your company settled in. That's right.
Mm-hmm. Absolutely.
Excellent. Well, with that, we'll see you on the next show.
Thanks,
Josh. Sounds good.
All right. Take care.
Thanks for tuning in. I hope you enjoyed the call and that you have a better idea on how the economy is doing and how it works. To learn more about real estate investing or how to be a capital partner, visit our website at www.everythingaboutwealth.com. If you like the show, make sure to subscribe and like us on iTunes, YouTube, or your favorite app. With that, see you on the next show. Take care.